Good morning, everybody. Happy Wednesday to you all. It is now 11:04, and we will now begin with Steve Tabrizi's housing market update. Steve, go ahead.
Good morning, everyone. Hope you had a great Wednesday morning. Welcome to another episode of the Remax Hallmark Market Report. In this market report, we basically covers for the last 9 months, in particular the last 6 months since the start of the COVID. And we try to also touch base as what is happening beyond the COVID and going into the fall market and perhaps even the early stage of the 2021. So let me start by sharing my screen and then we go from there. Okay, so the agenda is COVID key metrics, early sign to gradual recovery, and Ontario real estate trends, the current housing assessment, and Ontario's outlook key factors. For the last 6 months, there were at least about more than 20 forecasts with respect to our market. And interestingly, most of the forecasts, they were negative. Starting by RBC in April 1st, headline was home sales in Canada could drop as much as 30% this year. Capital Economics on April 20th, Canadian home prices could drop as much as 5% due to the COVID-19. CIBC May 4th, forecasting Canadian home prices drop to 5 to 10% relative to 2019 level. And another one, Morningstar, May 8th, home prices could drop anywhere between 14%. And as you can see, everybody was surprised what was going to happen to our market. Everybody was predicting because of the uncertainty and a crisis, health crisis of the COVID, we will definitely have a halt in our market and the market will drop, particularly because month of April and May, the market dropped by almost 70% in activity and the transaction was at the level of anywhere between 30 to 50% depending on the different market. But everybody was surprised as soon as the June started. So let's see what was the 5 key metrics during the COVID. The number one metric that really caused that a psychological boost that the consumers, they feel comfortable that go out there and spending money and buying homes was government support. Some people criticize the Canadian government in terms of the spending and in terms of the unlimited support that was thrown on the street and the funding. But the fact remains the same, that if the government support wasn't there, the psychological impact could have had severe impact on our economy and particularly real estate market. Employment still remains a big factor. At the beginning of the COVID, we lost almost 3 million Canadian. Before going to the COVID, we had a 5.5% unemployment rate, which roughly represents about 1 million people in Canada. At the peak of the COVID, we had almost about 16% unemployment. In month of June, we recovered almost about 1 million. In month of July, we recovered almost another 500,000. And in month of August, we have recovered another 300,000. We are still short by about 900,000, shy of about million in terms of the return of those employees back to normal work, and mostly in the sector of the hospitality, travel, and accommodation. Right now, our unemployment rate is sitting at about 10%. And perhaps if as soon as we get September numbers, we probably will be in a single digit, sometimes around the 9%. And hopefully by the end of the December, end of the fiscal year, we should predict that we should be around about 7.5, depending on the second wave of the COVID. This was the biggest factor in terms of boosting our market, low interest rate and financial liquidity. The federal government, through the CMHC program, supported the bank, making sure that there are injection of the liquidity of the asset into the market and low interest rate. Average mortgage rate, 5 years rate, has been anywhere between about 1.4 to 1.8. It's basically unheard of. And many Canadians are taking advantage of the low interest rate, and they are locking and they are purchasing their properties. Vaccine. Of course, the hope for vaccine is on the horizon. And from the beginning of the COVID, public health assured consumers that within a year, which probably we are looking anywhere between the November and February, the first vaccine should surface. Most credible vaccines are on the third trial, and which is their last trial. And that's where we will see the turn of the market, sometimes probably in early months of 2021. And immigration. Immigration has always played a big role in Canadian real estate market. We will touch on immigration on further slides. So let's take a look at the Canadian job recovery. As you can see, we basically by early August, we are now sitting at about 10.6, and most of the job losses are in the sector of the hospitality, food industry, travel industry, but it's rebounding quite healthy. Most of the job losses are also on a part-time job losses, below average income of roughly about 35,000 on an annual basis. Changes in the employment situation due to the COVID-19. There was a survey was done by Altus, and this survey basically asked the consumers, if you lose your job, how much impact will have on your housing, spending, affordability, paying your commitment in terms of the mortgage. And as you can see, laid off temporarily and laid off permanently played a very small percentage in entire of these stats and in this survey. You can see also on the top, was not working before the COVID-19, almost about 16 to 14% of the people. Earning a similar amount of the money before the COVID, almost half of the consumers, they're earning the same amount of the money. So the perception of the higher rate of the unemployment and the people don't have the ability to service their debt really does not exist. Mostly this is the message that is played by the media rather than providing the details and proper survey that it was done by the multiple resources. Reason for wanting to buy a home. Number one reason, low interest rate. Number two, consumers, they really feel this is the best time to buy a property. Again, goes back to the number one. My current home is no longer suitable. Many consumers also realize perhaps the changing of their lifestyle during the COVID and perspective of their lifestyle. Some people, particularly in the GTA and in the core, they realize the value of their property. They have appreciated substantially over the last 10 years, almost by about 120%. This is a perfect time for them to basically liquidate their asset and reposition their homes into suburb area and buying smaller homes, or move to other urban centers such as Ottawa. There was a media release for the last probably 90 days asking people difficulty in terms of the mortgage deferral. Once the mortgage deferral is which ended almost about a month ago, the perception was many people will basically have difficulty to service their mortgage, and we will face a large number of the power of sale or foreclosure. Same company did the survey, and if you can see during the survey, majority of the people, almost 76% to 83% of the people, they said, I will have no problem making my regular payments. Almost about 15%, they basically mentioned, I will make my payment, but I may have some difficulty. So therefore, what do you hear on the media about the difficulty of the mortgage deferral? Now it's ending and consumers have difficulty to pay the mortgage payment. It's really not the real reality. Again, goes back to the government support, because the government support has subsidized the issues that the consumers may face. So what's happening in Ontario and real estate market trends? As you can see, the biggest growths are in the smaller urban cities such as Ottawa, such as Durham, such as Simcoe County, that they have almost a 9% increase in the prices. And you can see in the area surrounding the Toronto, Hamilton, Mississauga, Niagara, Brampton, 4 to 8%, and some cities such as Waterloo and Kitchener, due to the loss of employment in multiple sectors, the growth has been below 3%. Let's take a look at the GTA homes. We had a tremendous 9 months growth, particularly started in the month of June and all the way to last month, even in September. As you can see, the activity in a detached home, semi-condo and townhouses, everything has been double digit, anywhere from about condominium apartment from 11% to detached home, comparing to the same period, August of the 2019 to versus August of 2020, almost by 50% increase in activity. This increase in activity obviously has portrayed itself in what price range, what sector. For GTA homes, the biggest area of the movement has been homes below $1.5 million. And that's where multiple offers, as high as almost 30 or 40 multiple offers are happening. So anywhere above the 600 to 1.5 million is a soft spot where the consumers have the highest and major activities. Luxury market is moving, but luxury market is depend on the inventory level of the certain area. Some areas such as North York, CO7, CO14 is moving at a slower pace versus Lawrence Park, Forest Hill, because of the lack of inventory and lack of the speculator investor in that area is moving as healthy as before. Now, the increase in activity also correlated to increase in the prices, August to August. Condominium, although perception out there is that the condo market is slowing down, yes, it does, which we will talk about it at a further slide, but had an increase of 10% in the prices, and a condo townhouses 14, 18, and 20% on a detached prices. Technically, detached prices at the end of the August in the GTA is sitting at the $1.172 million. Now, if you want to take a look at also the condo market right at the beginning of the pandemic reached in a Canada-wide, it reached its peak of the momentum. So the average price of the condo in Canada around April was sitting at anywhere around about $487,000. In Toronto, the condo market was sitting close to about $610,000, where was the peak for the month of April. Condo GTA purchases, again, it's happening anywhere in the range of about $400,000 to $800,000. That's where the affordability area does exist. Anything above the $800,000, you will see less transaction in terms of comparing August to July. And you can see for the first time in August, we have seen small sort of a retraction of the condo activity starting, and in month of September we have noticed about more retraction in terms of the activities, probably dropped by about 10 to 15% in certain areas. Suburb, GTA suburb market, as you can see, the biggest gains are in the areas such as the Burlington, Whitby, and Oakville, Clarington, and Oshawa, and all these areas are basically suburb of the city of the Toronto. And you can see the growth in the higher expensive market areas such as Richmond Hill, which average price is sitting at about $1 million, is a lot less than an area which is such as Whitby. So consumers are moving more towards the suburb and going away from the downtown core. So Ottawa housing trend. Ottawa housing trend followed the same pattern as the GTA. Most activities, this is basically from our appointment center statistic that shows that all the number of the showing, mostly majority of them are happening anywhere in the range of about $300,000 to $800,000. And if you take a look at also the activities and a multi-million-dollar home or luxury home in Ottawa, even between $1.5 million to $1.9 million does exist, and literally fade in around $2 million, so the activities are less. If you take a look at the soft spot in Ottawa, which is $400,000 to $500,000 home, we had for the last 9 months almost about 26,000 showing just only in that frame of the price range in Ottawa. So what's happening in Ottawa home prices? Ottawa average versus Ottawa benchmark. The most important thing is Ottawa average. As you can see, the Ottawa average is growing gradually. It had a drop sometimes in March and April, very similar to other market, but from that point is continuously is growing on a steady curve going upwards. And this is an interesting graph, the Ottawa home purchases. Everybody, although with the market has been quite robust and quite hot, we have not even reached to the peak of our 2017 and 18. So the 2020 prices, although they are increasing, but the peak still was sometimes around the April of 2017, as you can see in this graph. Condominium prices in Ottawa are growing on a steady paces. Ottawa average of the condominium prices are sitting anywhere from about $370,000 to $385,000. Again, similar format, the peak, actually the condo prices in Ottawa, it's really getting close to the peak of the 2019, and it surpassed the peak that had in 2017. So the condo prices in Ottawa is almost in certain areas is the highest peak that ever reached was probably at about 475,000, and right now it's sitting below 450. Simcoe County region. Simcoe County region, the medium of the all homes and a metro, you can see it has a steady growth. We have noticed a little bit of the drop in month of September, which we related to the basically end of the pent-up demand and reopening of the school, which has caused major chaos and concern for families, and therefore we have noticed that the market is sort of settling to maybe a new normality, but still the prices compare to even December of the 2019, you can see is in steady upwards. Days on the market. This is a very clear indication of the soft spot market in Simcoe County, anywhere the price range of the 500 to 750, which is the most affordable price range and the most attractive price range for the consumers that they are moving into that area. And the days on the market sitting at almost 12 days. The days on the market comparing to the same period last year was almost from about 30 days, and now in that price range is sitting about at 12 days. And that's a real indication of the lack of inventory. So month of inventory in Simcoe County literally sitting at about a month and even below, probably 0.9 of a month. The current housing assessment. So what happened to the situation that we have in all the region that the Remax Hallmark operate? We basically try to explain to you the GTA. GTAs include of the Toronto, York, and Durham, Ottawa region, and a Simcoe County, which include the Simcoe and Barrie. So overheating supply versus demand. So we are still facing the same issues that we have talked for the past several years. There is not enough supply and the demand is increasing on a steady basis. The demand this time is increasing because of the low interest rate. Tremendous opportunity for buyers, particularly the first-time buyer, to buy properties, and they are taking advantage of this opportunity. Many people who also bought condominium in the GTA, perhaps during the last 3 to 4 years, I would say perhaps people that they bought in the era of the 2015 to 2017, they built up great equity within their condominium markets and with their condominium ownership. And now they see the opportunity to basically liquidate that condo and the opportunity to go to the suburb area and buy a freehold property, semi or townhouse or detached. So the supply is not there, and the supply will continue to be a shortage of supplies for years to come. Price acceleration. So when you have a low supplies, automatically the prices are accelerating. And overvaluation, price versus disposable income. This is related to affordability of the consumers. The good news is, for the first time, the affordability of the people in Ontario has actually increased. Their disposable income that they use for the purchase of a home or for a payment of their mortgage or servicing of the mortgage debt is actually has dropped from about 74% to 64%, and mostly due to the COVID-19, to the government support, to less spending money going out there, less traveling, less dining out, and less perhaps shopping. So overbuilding. Are we overbuilding properties? Not in a freehold market, maybe in condominium market, because of now the lack of the appetite for some investors that they used to scoop these overbuilding project. Maybe in 2021, we should see a little bit of the overbuilding of over inventory of the condominium market. So let's take a look at the comparison between the February of the 2020 and September of 2020 reports, degree of the vulnerability in our market. So the green is basically represent the low vulnerability based on the previous assessment. The next slide is basically based on these 4 elements, and the yellow color is moderate and the red is high. You can see, with the exception of the Victoria in Canada, that is basically February was quite high in terms of vulnerability. Pretty much in Ontario, in Toronto, in Hamilton, in Ottawa, we are in a moderate vulnerability. We are reaching to the point that basically our prices are catching up to the peak of the 2017, but we are not there yet. So yes, the activity is out there, is amazing. Yes, we have multiple offers, but the prices has not reached to 2017 peak, and mostly due to the mortgage stress test that we had a drop of the prices in the era of the 2018 and early 2019. So let's take a look at the market surrounding the GTA. 12 markets surrounding the GTA, they basically had record-breaking above their average home. And if you take a look at all those red area of the map, most of them are suburb. You can see, for example, the Pickering, as an example, average price at the peak of the market right now is about $973,000, but at the peak of market was $71,000 more than what is it today. But other areas, they have established a new peak for themselves. Toronto home prices are 5% lower than the 2017 peak. And you can see also in the Simcoe County, Innisfil, Essa, there are the new peak, new prices are established in those areas. And even in the western part of the GTA, Mississauga, Burlington, Halton, that's where you see the consumers are moving. The gray area is not at the peak price. So that's the area that you and your client should focus. One of the area is a Georgina, one of the area is Aurora, one of the area is a Newmarket, Caledon, and you can see those areas, they still have room to reach the peak of their market, which was 2017. Although we all agreed that the 2017 was not the greatest market, that we wish to be in that market because it was unsustainable and it was not healthy. But as you can see, we reached to those points at some time in early 2017. So the perception is that basically the expectation is that we should be back in those areas if the market and continue the same momentum that we have right now. So York Region average prices are down 11% from 2017 peak. Yes, people who bought between 2000, perhaps they bought in late 2016 and early 2017, they may not recover what they have paid for, but there's an opportunity for people that they really want to move into that area. So there is a gap in terms of reaching to that peak. So let's take a look at the average prices in Ontario. Average prices in Ontario in 2020 has increased by about $100,000. In Aurora, the average prices went up by $149,000. In Richmond Hill by $130,000. In Toronto by $106,000. And in Ajax by $95,000, $82,000, and Pickering by $74,000. And even in Barrie and Ottawa, you have about 67 to 73 respectively. So if you take the average of all the areas that the Remax Hallmark offices and agents are operating, by average, most area they had a double-digit growth in terms of the average price of their homes. So Simcoe County, the average prices in Barrie is about $633,000, and in Simcoe County as a whole is $660,000, and Innisfil is $673,000, and Aurelia is $478,000. You can see a steady growth, and everything surrounding also the greater Simcoe County is growing at a steady pace. So is the condo market most vulnerable? This is $1 million question that everybody's asking us during perhaps the last 2 to 3 days. Or maybe I would say in the last month is the hot topic of the media. So let's talk about what has happened to the condo market. We had 112,000 foreign students that they were residing in the GTA or in Ontario, some part of the Ontario. Most universities, most post-secondary education, even some high school, even some colleges or private institution, they are basically adopted the virtual education. So you have almost about 75,000 to 80,000 of those immigrants or those visa students that basically are not residing anymore here in Toronto. So automatically you have an increase of the inventory of the rental market. So when you got a softer rental market, so what's going to happen to the rental market? Who are the ownership of the rental market? Mostly investors. So what is the situation of the investor? They are in two categories. One category that they maybe leveraged themselves too much, and they were able to handle maybe a shortfall of $200-300 prior to the COVID, but now their shortfall may be about $500 to $700. But there is a benefit here. Many people are renegotiating their mortgages with their bank at the very low rate that, as we mentioned, average about 1.5 to 1.7. So they are trying to close that gap. So if you are an investor of the condominium market for a long run, if you can manage to reduce the rent of your unit and rent it at a very competitive rate rather than the rental rate of the 60 days ago, you shouldn't have any problem, because this is a crisis for the condominium market as a short period of the crisis. This is not a 5 years crisis, because as soon as the vaccine surface, you will see within the 6 months surface of the vaccine and distribution, you will see the return of the foreign student, the return of the immigrants. So there is also a sudden preference for more spacious accommodation. People who used to live in the condominium, that was their primary residence. So now they are cashing out because they know they made a good investment, they made good money, and it's time for them to sell and move to the suburb. So now you have the increase of the inventory of the resale, plus the also increase of the inventory on the rental market, which some of those rental market, the investor, the second category that they bought anywhere between 2018 and 2019, maybe late 2017, they really can't carry it, or they leverage themselves too much. So they are now coming into the resale market too. So it's very important in terms of the speed of the economic recovery. Yes, of course, if the COVID prolonged longer, so it will be more difficult situation for the rental market and the condominium market. But everyone believes, and I think when you look at the buyer's appetite are buying the real estate during the one of the most unheard crises in a human mankind, that people are buying houses, people are spending money, is the reason behind it that everybody firmly believes that this crisis is a short period of the time. This is not a 5 years financial crisis. This is not a 3 years financial crisis. This is a crisis that has a full support of the federal and provincial government. And as soon as the vaccine will surface sometimes between the November and February, I hope so. And then you will see it takes about 6 to 7 months for distribution. And then we will probably sometimes in September of 2021 and October of 2022, we will see the restart of the going back to the new normal. So let's take a look at the condo prices peaked only in 3 major markets. As you can see, the condo prices only in Vancouver, in Toronto, and in Ottawa and Fraser Valley peak. Most of the other market, it has a basically retraction of the condo market. So the condo market is slowing down, and it's slowing down at the rate of currently about 3.5%. Ottawa benchmark reached almost about 371,000, up in August by 21%. Montreal was up by about 14.6, about $317,000 the average price, and Oakville by about 10% to $612,000. So if you take a look at the drop in the condo market, you can see the Toronto slightly, this is a August stat, is about 2%. I think the September we had another maybe 2 or 3%, and depending on which area of the condo market it is. So we should be at the negative of about 3.5 to 5% in terms of the prices of the condo. In terms of the rental, we are sitting at about anywhere between about 6 to 10% drop in the rental rate. Condo activities, of course, decline, but yet the prices are increasing. Yes, in the second quarter of the 2020, we had 42% increase in activity of the listed condo, but we only leased 24%. We had a minus 24% drop in the lease activities. But as you can see, the prices hasn't dropped that much. As on a previous slide, we demonstrated that basically the prices only dropped maybe by about 1.5 to 4%. So condominium apartment summary in the second quarter of the 2020, TRREB total was about 3,459. Average price is up. Even if you take a look at the average price of the 2019, 589 versus 619, pretty much in most market, the prices were up, and with the exception of the Durham region, that the prices of the $416,000 was dropped to about $409,000. Why? In that area, the prices drop because consumers are more lenient towards buying a freehold property such as semis, townhouse, and detached prices, because it makes more sense in terms of comparing the prices and lower interest rate to buy that kind of properties in that area. Permanent residence is declining. There is no question about it. Although there is a COVID, it's happening, but there was about 4,450 permanent residents admitted in month of July. We're down by about 64%. And year to date, there were about 69,000, 70,000 immigrants. They were admitted to the country. We are in Ontario, we are down by about 40%. Ontario usually represent anywhere between about 120 to 150,000 residents. And that's one of the areas that the federal government and provincial government are working very hard, trying to make sure that how we can bring the immigrants safely here. As you know, one of the #1 cause of the spread of the COVID is travel. So Greater Toronto, so condo market rental is slow. Resale is slowing down a little bit. Talking to many of Hallmark agents that they are specializing in assignment is also slowing down. But contrary to a pre-launch and pre-construction had one of the best month in the month of the July. We actually had 2,539 new units were launched versus the July of last year, which was 728. We don't have the number for August or September. As you can see, the number, they were quite less in month of June because the June was the beginning. And it seems why there is still appetite for pre-construction. Consumers, particularly the investors, they rather to invest in a property that they have to worry about it 3 or 4 years from now. Builders, they have come out with the amazing incentives such as lower down payment from 20% to 15%, and also spreading it over almost 2.5 to 3 years. Some developers, some large big developer such as RioCan, they are offering even interest on a deposit of the consumers, free locker, and consumers are leaning towards that because most of the people that they are really buying the pre-constructions either are investors or they basically don't have enough the down payment to take the mortgage, so they rather have the less down payment. So versus buying the resale. Why? Because the resale, now the investor has to worry about the rental, carrying it, and serviceability of that product. Number of the project has been quite phenomenal. Frankly, during this COVID, we had at least about 7 or 8 projects that were launched and presented to the Hallmark agent. And most of the project, they had over 60% of their units that were sold. In month of July, we just had about 9 projects that launched. So property transaction by asset. This is the commercial class. As you can see, the residential land in 2020 versus 2019 is retracting a little bit. Obviously, the bigger player in the market, they are watching the market, they are looking for opportunities. That doesn't mean they are not shopping. It's actually the best time for REITs and the big developer to shop. And you can see the area that really had the biggest attraction was office, and the biggest growth was the industrial. And the industrial is because of the services of the goods, because many companies are gone online and they're basically revamping their retail location. And basically what they need the warehousing and logistic plans in order to service the delivery of the product that they sell online. Apartments are really around the same peak as from the 1.2 billion to about a 1 billion, but overall is healthy, and overall for the commercial players is tremendous opportunity right now out there in the market. And even with the offices, it was interesting right at the beginning of the COVID, there was a survey done that many employees or employers, they said they prefer work from home. And the same survey was done about a month ago. And now they prefer to be back at work because of the productivity of their employees. That is not the same while they're at the workplace versus they're working virtually or they're working at home. So top 15 preferred product markets, as you can see, they're still lining up in Ottawa and Toronto. Ottawa, suburb multi-unit residential. Toronto, food anchor retail strip. Any plazas that has a food anchor, it's becoming quite valuable, because obviously during this COVID, 2 sector was essential, medical and food. In Toronto, even suburb multi-unit residential is growing at a steady pace, momentum ratio buy versus sales. And in Ottawa, single tenant industrial. And you can see the negativity is mostly in the regional mall and in basically the area of the hospitality and retail. Rental market, we did a comparison only for a 1-bedroom, so everybody understand what's happening in terms of the 1-bedroom. You can see that Toronto for the last 6 months had a drop of about 10%. Mississauga had about 1.4%, North York 6%, and Ottawa is actually literally at par. Ottawa, really, the rental market hasn't really moved. It's basically actually about a 1% up, because the amount of the inventory in that market is not quite as high as the GTA. Simcoe County doesn't have that many condominium or apartment buildings, so I suspect it should be around the same momentum. As you can see, the biggest drop is in the downtown, and it's probably in the area of the CO1 and CO8, which is the density of the condominium market is there. But let's think about the perspective of 10%. So if the September of the 2020, the rental market of Toronto for a 1-bedroom is sitting at $2,013, which means was about $2,200. Most of the inflation of the price increases of the rental market happened due to the pre-construction market, when the condominium were selling at the range of about $1,200 to $1,300 per square foot. Of course, for investors, they have to increase the rental market. And frankly, I think this adjustment on the rental market overall is good for our market. Why? Because the consumers, rather than renting, they prefer to buy. And I'm sure many real estate practitioners, they prefer to deal with the buyer and sellers rather than with the rental market. And the rental market will adjust by itself, because I strongly believe the city of Toronto or province of Ontario, it's a global center. It's a place that many immigrants are attracted coming here. So the investor will continue coming back to the GTA and Ontario, and they will invest further and further. And this is, again, maybe a crisis of about 9 months to 12 months. And by mid-2021, we should be fine in that area too. So the share of the income a household that need, as we discussed it earlier, has dropped. So now the disposable income that you need to spend in terms of servicing a condo or single or aggregate long-term has dropped to anywhere in the range of about below 60%. So depending what type of properties you have, which is a great news. And mainly it's because, as you can see, the government support, lower interest rate, decline in utilities costs that the provincial government implemented during the COVID, and lack of the shopping and lack of traveling and spending. So it's allowed the consumers to really do a catch-up game in terms of the affordability. This was a report was done by Sukasa, which is an interesting report, and that's one of the report that got a lot of media attention, that the city of Toronto is not affordable anymore to buy, and you should basically, how long does it take you to pay off your mortgage? But you can take a look at it at a different angle. An average amortization of a mortgage is about 25. Majority of the people are now in maybe even 30 years amortization, and there are now certain institutions now again are offering 40 years amortization. If you take a look at the green area and the yellow area, which is below 20 years, even the red area, which is basically, we are not talking about 22 years average, even if you assume the amortization is 25 years, the question that you should ask any consumers, do you rather own a property even although it takes you 22 years to pay it, or do you rather have renting a property because it's going to take you 22 years to pay it? So I think, frankly, this report is a great report, and how you look at it is make a difference. I look at it as an opportunity. I look at it in many yellow area in the city of Toronto, EO4, EO8, EO9, Ws, that basically there is opportunities are there to buy, and you can basically pay off your mortgage anywhere in the range of about 16 to 20 years. So I would continue encouraging the consumers to buy. Yes, there are certain areas such as CO2, CO9, and C12 that basically are becoming more expensive and more and not affordable, but you got to remember those are the areas that basically are a second buyer or third buyer will move to that areas. So 22 years, every year, every mortgage payment is represent almost about 30% of the principal payment that you pay. And they have not even factored in this report the appreciation of the market, which is basically average historically in Ontario has been about anywhere between 4 to 7% depending on the market. So Canada's GDP is recovering very steady, slowly, and you can see the area that is really lagging is accommodation, food. But if you take a look at the real estate and rental, is actually February and April that had a decline, but February to July, the forecast, as you can see, is now on a positive note. Is it the same momentum that we are expecting to have? No. But we are in a sector that basically, due to the construction, due to the finance, due to the service, is going to have a continuous momentum of the growth. And even the manufacturer, if you take a look at the manufacturer, you can see the -20 or -30% drop is now retracted to about -10 or -15. So it's just a matter of the momentum of the building the economy back. And most of this momentum is done due to the right decision by the federal government, making sure that there is a liquid cash and asset on the street. The banks are supported. The banks are continuing the lending, doesn't matter residential mortgage or businesses, and also the government support. Yes, I know there is an argument out there that who's going to pay for all this funding that the government provide. Yes, many of our younger generation, children's, they will pay it for many years to come. But do you rather to crash the economy, which would have taken us at least about 5 to 7 years to revive it? Or do you rather we basically support the economy and basically come with a solution down the road in terms of how we can service this debt that we accumulated during this crisis? This is a global crisis. This is not a crisis that only alienated Canada or any other country. And I'm sure there will be a solution also down the road. So let's take a look at some of the regional comparison as how you guys have performed. Hallmark versus the TRREB, which is pretty much the GTA. So average listing sold price for a TRREB has been $776,000, and Hallmark agent, they basically perform almost 7% above the TRREB average. So average Hallmark prices are $828,000. Sold to listing ratio, Hallmark agents, they have performed at almost 3% versus the TRREB, which is about a 101. So these numbers are great number for you to demonstrate to your clients that what is the difference of the choosing a Hallmark agent and Remax Hallmark versus other companies that they perform in the market. The ratio of the new listing, sales versus the new listing, Hallmark is sitting at a 65 versus 58 of the board. And average days on the market, we are 19 days versus 22 days. That means all your listing are selling by almost 14% faster compared to the market. Let's take a look at Hallmark versus SIMCOE County region. So average listing on the SIMCOE County region, BDAR is 571, Hallmark is 587. So we are above the market by 3%. Sold listing to the ratio, Hallmark agents in SIMCOE County are 100%, 101 versus 99.1. And a transaction, this is a very interesting regarding the Simcoe County market. Simcoe County year to date, they have done 7,001 transactions from January 1st of 2020 till September 30th. Hallmark represented 2,596%. We represent 37% market share in that area. New listing ratio to sales is 95 versus 92, and average days on the market 23 versus 25. So we are selling them 8% faster. Other market share in the GTA, it's a large geographic area, but it's sitting at almost about 10.5%. So if you want to take a look at it to the perspective that basically imagine if the TRREB does about 100 transactions, so we represent almost 10,000 of those transactions. In a smaller urban centers such as Simcoe County or Ottawa, so our numbers is quite higher than the GTA, because the GTA represents almost about a 7 million population, and Ottawa is 1 million, and Simcoe County is probably about 300 to 400,000 people. I don't have that accurate number for that area. Hallmark versus Ottawa. That's another fascinating number. Year to date, Ottawa has done 14,241 transactions, and Remax Hallmark proudly has done 4,896. 34.8% of the market share belongs to you guys. Congratulations to all of you for achieving such an amazing number. So imagine out of every 3 homes, 1 transaction is done by you guys, either buying or selling. Average days on the market, 17 versus 24. 30% you're selling the homes faster than any other competition. Average sold price, you guys are 4% higher than your competition. And the ratio of the new listing, sales to the new listing is 83% versus 80.3. Some Remax Hallmarks fun facts. So showing. We accumulated all the showing of our appointment centers. We have done year to date 240,000 showing. We have done 14,000 transactions, shy of the 14,000, 13,979, I believe, transaction. So the number of the transaction is almost by 5% down compared to the last year. Let's watch the next slide. So sorry, the next couple of them. The new listing, we have done about 12,383 listings. Average days on the market in all collective 5 region of the Remax Hallmark is 24 days. Average price collectively is a 7.4 up. And this is the slide. Although we are down by 5% in terms of the number of the transaction, but we are up in terms of the volume, which basically the indication of the average price is increased. We have done so far $7.5 billion, and we still have another quarter to go, and we are up in terms of our volume by 3.8%. Congratulations to all of you. So how long do you think the interest rate will last? This is the biggest caveat, the biggest sort of the boost for our economy, and the interest rate will stay low probably till early to 2022. And then even if there will be an increase, will be very slow incremental increase in 2022. Over all the 5 years average of the growth in Ontario, it's amazing. Look at the Ottawa, over all the 5 years average, it's been growth of the 53% for single residential family and 46% for condominium. Greater Toronto area, 78% and 51%. So if you divide all those percentages by 5, you will see in some areas we are double digit and some areas we are single digit. So Ontario, Canada overall had a growth, and you can see in a very some other minor provinces such as Winnipeg that you will see a minus 3% drop. Of course, the resource, the oil region of the Calgary and Edmonton has highest drop because of the lack of the employment in those areas. But the Greater Toronto area, Ottawa area, Guelph, Hamilton, Burlington, Vancouver, everything is a double-digit red hot, and the market continue to grow. And this growth will continue from if the nucleus center is Toronto, it will go continuously towards the suburb. Consumers are comfortable with the traveling now to Barrie and Simcoe County, are comfortable to traveling to Durham, to Clarington. And during the COVID, one thing probably you all have noticed, massive infrastructure in terms of the road transit, it's happening simultaneously because the provincial and federal government are creating jobs, and they want to basically keep the economy's momentum going forward. So why Ontario will be fine and there won't be nothing gonna really major or drastic happen. Ontario is the hub of the finance for the country. Huge employment sector in the insurance and administration. Real estate is the biggest hub in Canada. 14.9 million people live in Ontario, pretty much almost 45% of the population of the Canada. And it's now a new tech hub too. So COVID also caused many other tech hub move to Ontario, particularly from the US. So the employment sector in that area and innovation is quite strong. Is the largest consumers market and largest financial markets, a vibrant labor market, so there will be a demand for work. In some areas, such as the Barrie and Simcoe County, actually the unemployment rate is now single digit, is sitting at about 8.7%. So you will see many companies may move to the suburb area for lower the cost of their operation, and it will improve the employment rate in those areas. A realistic outlook, we will suffer unemployment mostly in lower paying frontline service job, hospitality, hotel, on a full-time sectors will be basically mostly airlines industry and travel industry that will suffer probably for the spring of next year. But keep in mind, as soon as the vaccine surface and as soon as the distribution start, you will see a massive recovery of these sectors, because psychologically the consumers, they want to go spend, they want to go travel, they want to do things that they were not able to do in the last 8-9 months or the next 3 to 4 months. So there will be a tremendous instant recovery on those markets, but we just need to find a solution for those industry for the next 9 months to 12 months to sort of survive, and that only solution for them will be through the government support. Fall will remain very robust. We don't predict that the fall is going to be a massive drop in any sector of the real estate market in Ontario, even in the condominium market. As long as you list it right, you price it right, you should be fine. Keep in mind, when you talk to the consumers, if the consumers are on this call today, you have to realize if you are an investor, there is an angle of the cash on cash. If you put $100,000, bought a condominium 5 years ago, and you have a mortgage, the mortgage is the borrowed money. The mortgage is not your money. The mortgage is basically an opportunity, and a system does exist in Canada that basically you can buy a property, compared to many European countries that you have to put 30-40% down payment, or even Far East countries that you have to put even 50% down payment. So if you put $100,000 from your own cash, from your own liquid asset, and then even with the adjustment of the prices of the condominium in the last, let's say 4 years or 5 years, your $100,000 becomes $75,000. So you got to calculate the $75,000 ratio versus the $100,000. So your rate of return is 10-12%. If it's a primary residence, it's a tax-free. If it's investment property, you adjust the tax that you have to pay to the government. You will be still, I've done this calculation many times, you will be still at a single-digit growth of the anywhere between 5 to 7%, which is better than any bank investment or any stock investment or any GIC investment. So the market is healthy. As long as we understand the set of our expectation, we cannot always consider that because of the last year, I could have sold it at this price. No, my expectation is to sell it at this price this year. No, be realistic and just basically move on with your plan. The government support is going to be there. The government has no other choice, and they have proved that they are committed to supporting the businesses, to supporting consumers, and I'm sure everybody is happy to see that. Household spending will increase. It's shifting towards a different format, perhaps mostly online. The second wave is here. The second wave is mostly rooted back to school. Probably we might see that the schools will scale down, be more virtual. Many parents have chosen to be more on a virtual in terms of the education, and probably the household spending will be more from the inside of their comfort zone home, which is mostly online. But its industry, the traveling industry, has a massive recovery of the booking for 2021. With incentive of the 100% cancellation. So many of those industries are actually looking forward to 2021. And of course, US election is a big part. Hopefully, we will have someone in the White House that basically is more reasonable than the current president. I don't see no major evidence to put a downward pressure on the home prices. The only pressure that I might see will be from the immigration sector, but I think that pressure from the immigration sector is really sort of relieved by lower interest rate. This is the only time and only era many Canadian, many Ontarian, they see that the total opportunity for them to buy a property, because where can you find the rate of the 1.5 or 1.7? You should advise many of your clients to renegotiate their mortgages with their bank, because this is a one-time opportunity, and you blink your eyes, we are in 2022 and the rates start going up. Economic outlook, of course, the number one is how soon the vaccine will surface. Labor market is the key factor, because as soon as the vaccine surfaces, the labor market will basically, hopefully, will go back to around the 5.5 to 6%. Even if by the end of the December of the 2020, we'll land up in a range of about 7.5 to 8%. It's considering coming from a 16% 3-4 months ago. It's a great recovery. Bank of Canada will continue the lower policy rate, and second wave, as you notice, everybody was concerned that we're going to go back to get lockdown, going back to phase 2 or phase 1. But I think the provincial government and even federal government has demonstrated they rather to tweak all their restriction. And the same way with us as a company. We will monitor the situation on a daily basis, on a weekly basis. And if we have to tweak it and we have to impose tougher restriction, we will do it, because the safety and health of our staff, you and your clients, is our primary goal. And the same thing with the government. So be safe, don't drop your guards, continue practicing the way that you have demonstrated in the last 6 months. that you are professional, you are ahead of the market, you are performing by average anywhere between about 3 to 5% above the market. You are netting your clients anywhere between 3 to 5% more money. You're selling the properties at about 15 to 20% faster. And these are the requirements that the clients, the consumers out there are expecting for you. They're expecting a different experience, and you truly have demonstrated the different experience through the last 6 months. Thank you very much. I'm here for all your questions. So Shant, any question? I'm all yours.
Thank you, Steve. That's actually really great information. So we do have some questions. I want to start off with David Brown. He's asking, we have gone from a checkmark recovery to a K-shaped recovery with a growing distance between the have and the have-nots. Do you see any fallout from failing sectors of the economy like restaurant owners and small businesses as a drag on our sellers market?
David, great question. Realistically, yes. We have to be realistic. Restaurant business, it's a very tough sector. The profit margin, the gross profit margin for the restaurant business, depending on the size of the restaurant, who are getting impacted, mostly small restaurant owner operators, family operator, that their profit margin in the restaurant business has been always tough, about 18%. So what is going to cause them a problem? The number one is their overhead expenses, which is the rent. Over the last 7 months, we have seen a tremendous support from the actual commercial owners supporting their tenants, because they realize if they force them to vacate the property or bankrupt them, the chance of re-renting is low. As long as there is a compromise, they can survive. But I'll see definitely a percentage of that market really evaporate. It will create opportunity for resurgence of the replacement, which, yes, indirectly will impact their home ownership. It may not impact their principal home ownership. It depends on how they leverage themselves. This morning, there was an announcement by provincial government, particularly towards that sector, that they are working on providing a grant and a loan to this small sector. City of Toronto in particular and Ottawa working on extension of the patios and maybe perhaps provide the heated patio. But either way, even the patio or heated patio will not help to reboost 100% their business. They need tremendous help. And answer your question, yeah, it will impact them. That's a part of any crisis. Is it going to overall impact our market, that our market really see a major drop? No, because the percentage of the people in the home ownership category of these restaurant business correlated to the home ownership is maybe represent anywhere between 5 to 8% of our market.
Okay, so next question comes from Lance Chilton. According to our bookings, on average, 60% of our inventory in Simcoe County is going to GTA buyers. How much longer will GTA exodus continue?
This is a very good stats. It's not only the Simcoe County, even Hamilton, Wentworth is facing the same thing. Last month, the GTA agent represented 46% of the transaction in Hamilton and 40% in Simcoe County. Lance, this will continue because the COVID caused the consumers realize the perspective of their lifestyle. There is an old saying that say cash is the king. So do I need a $2 million bungalow in the city of Toronto? What is the circumstances of my lifestyle? Or somebody who has a condominium in downtown Toronto that is worth $700,000, but is a 600 square feet, and they are dreaming to have a home that they can have even with the current situation in Toronto. And frankly, even if the prices drop in Toronto by 10%, they won't have that dream in Toronto. So that push will continue. And I think the consumers are, up to before COVID, they were in the sort of a resistant period of, I don't want to travel. There was so many stats. Why should I sit in my car, travel from Barrie to Toronto for work for 2 hours a day? Why should I do the same thing from Durham? But now with the flexible hours that are offered by the employers, and I think this will continue in the future, probably we will have the presence of the working in the office, or maybe some days work from home. This will continue the momentum. And even with the surface of the vaccine, guess what? The Toronto is going to get more expensive, more expensive. So eventually in the next 10 years, right now, if you travel east all days, basically you felt there was a disconnect between the Toronto and Durham region, Pickering, Ajax, Whitby. Right now, if you travel, you literally feel that it's a one city. So within the 10 years, with the development that is happening in Innisfil, Angus, all those areas, particularly Innisfil, I have a feeling that basically Barrie will be part of the GTA. The GTA map, it becomes greater and greater all the time. So this will continue. I don't see I don't see this as just a rush for now. It will be for at least the next 3 to 5 years.
Great. Another question from David Brown. He says, I think we will experience an up demand on foreign investment mid next year. Do you agree? Canada, GTA remains very desirable.
Absolutely. So we have demonstrated, compared to many countries out there, that how we handle this crisis. And what we demonstrated, it was the government support more than any, beside the public health, which they have done a tremendous job. Let's be thankful to the frontline medics, doctors, all researchers and scientists. But for sure, I see even that right now it's happening, David. I see the foreigners are buying from overseas remotely, engaging their agents here and buying properties. So it will continue. Right now, if Canada right now lift that travel restriction, I guarantee you that the Pearson will be flight after flights arriving of the people that they can come to this country. Right now, because of the restriction of the travel, is not happening. But it has not changed the perspective of Canada in terms of a safe haven, a great country to migrate, and a great place to invest.
Thank you very much, Steve. I believe that's all the questions I have. I do want to remind everybody that Steve will be back on at 1 o'clock along with John De Perez on Business 101, Budgets, Money, and Management Basics. So you could join him on 1 o'clock. If you're looking for that link, go to trainingandevents.ca and you could log in and get all the info there. Thanks again, Steve.
Thank you, guys. Take care. Bye.
Goodbye.